For those that don't know venture lingo, as it were, what you're asking about is what we call DPI, distributions to paid-in capital. How much money did the LPs give us, and how much have we returned against what they gave us? In contrast, TVPI, which is total value to paid-in capital, includes what you've given back, what you've distributed in cash, but also the current mark of things, how much things are being carried at. And in 2021, 2022, when all these crazy rounds were getting printed and unicorns were being created every day, every venture firm looked like they were geniuses because their total value to paid-in capital, their paper gain, TVPI, was massive, 7x, 8x, 10x. But the amount of capital they gave back to the LPs was like tiny or nothing, because in that kind of market, every entrepreneur and every venture capitalist are dreaming, wow, like my company was worth 400 million, now it's worth 2 billion. If I just wait another year, it's worth 4 billion. And every doubling of a company at that valuation creates 30 or 40x return. So like your desire is to see it go to the moon, and that the venture business is all about outsized returns, and therefore you never want to sell. And that's the trap, right? The trap is you're kind of constantly playing the top tick. And if you try to top tick, you're never going to succeed at it. And so it just demands that we need to not dream about what could happen, but we need to, I think, be grounded and say our job is to return capital to the people that gave us money. Like our job is DPI. And it's okay to like keep some of the capital in play and bet for the home run, but it's not okay to bet everything on the home run and then watch it blow up in your face. And so like, I believe like our business demands that, we drive to DPI. Now I think there's a nuance to it. Some firms, including Foundation Capital, have these they've decided we're not good at making the sell decision. We're good at making the buy decision. And so we're going to leave the sell decision up to our LPs. And some firms distribute the entirety of their position the first day they can. Union Square Ventures, by example. That's like an easy way to say, you know what? That's not our business. We got it to the stage. Let the LPs figure it out. Other firms, I think like Foundation, try to find a different approach, another rational approach, but different. And we say, you know what? Like we're going to sell some amount the first day we can. Maybe it's a third. And we're going to work a third out of our position, let's say over the next year, if we can. And then maybe like that last third, you've more than paid back your investment. Maybe you've more than paid back your fund. And now you can kind of use some judgment and optimism around what could happen for that last third. And if the last third goes to the moon, great. And if it goes to zero, you've already delivered a bunch of return back, and that's okay. So kind of there's these models like a third, a third, a third. I think there's a kind of a nuance that I learned from some PE friends that I try to apply, which suggests that a third, a third, a third is a good model, but that specifically, let's say to public markets and to a lesser extent, private markets that follow public markets, there are times when trading multiples, acquisition multiples are at their extremes. And there are times when they're at their depressions, at their troughs. And then there's times when you're kind of in a middling market, which suggests that you're not overhyped or underhyped. And I would say the tweak that I would suggest is pick a range. If you're within 60 or 70% of the standard trading range over a 5-10 year period for that industry, the industry is traded at a PE ratio or PEG ratio of X to Y, and you're inside that third quartile, whatever it is, like one third. But if you're at an extreme, let's say optimistic state where it's trading at a 50% premium to the top number, like push it out as hard as you can. And if you're at a trough and like stocks are depressed, just wait. Like why do it? If you're trading at 1 times revenue and the market trades at 4 to 7 times revenue, just be patient, because all these industries have cycles. And so I would say, try to have some pretty good rules, but modify when markets are at the extremes. And I think the industry did a pretty bad job over 2018 to 2021 of just like being like full greed, pedal to the metal, and not being mindful of DPI. And I think the LP community, they talk about this kind of denominator numerator problem where basically they had all this markup, and so the private equity portion of their whole portfolio suggested they were way up, but they were getting back no cash, and so they were kind of over allocated and stuck because they had no cash coming back. And I think it's our industry has a job of like recycling and returning money on a constant basis.